Another common style of equity credit line is the adjustable rate mortgage or ARM. With this kind of loan, the rate of interest will fluctuate betting on the half dozen completely different property indexes. The rate of interest changes that the investor of the loan gets a proper margin, that is thanks to the very fact that the indexes influence the price of funding that loan within the first place. Basically, your investor helps you to strive against a little bit of the interest risk rather than simply the investor like in a very fastened rate loan. This kind of loan will be nice if the interest on your equity credit line systematically falls for an extended time. You don't got to worry that abundant regarding the interest rates because even though they jump drastically, there are limits on how much your payments can increase. These limits are known as caps and mean that notwithstanding the size of the interest jump, you will not pay over a certain increase in a very sure fundamental measure. As associate in nursing example, an investor provides you an adjustable rate mortgage. It's a 1% cap for any half dozen month time frame and a 4% total cap for the complete loan. Your payments will increase the maximum amount as 4% at the maximum till the loan is paid off. That is not too shabby if you think about once interest drastically drops, you save a ton of cash. Every space within the country has completely different interest rates, thus you should browse Okurant it before you decide to travel with associate in nursing adjustable rate mortgage. Local newspapers sometimes embrace interest rates and predictions in order. That could be a great spot to travel to stay a watch on things. 30-year versus 15-year mortgages. Discussions of mortgages typically specialize in interest rates, however there's a lot of basic call to form. Do you have to escort a 30-year mortgage term or a 15-year mortgage term? 30-year versus 15-year mortgages. Any discussion of mortgages tends to show on 2 points. However, are you able to qualify for the foremost cash with all-time low payment? However, are you able to get all-time low rate of interest for the mortgage? Whereas these are two vital problems, there's associate in nursing edition one that folks fail to contemplate, leading to important wasted cash. The term of a mortgage is very important for a handful of reasons. First, it sets the length of the due to your enterprise. Second, it defines the number of interest you're reaching to pay over the lifetime of the loan. These are large problems once it involves building equity. The longer the loan, the lot of total interest you're reaching to pay. The trade-off, of course, is you're reaching to have smaller monthly payments the farther you stretch out the duty. Whereas this might sound sort of a smart goal once you first get the mortgage, it will backfire on you within the end of the day. Most people specialize in interest rates as the way to avoid wasting cash on mortgages. This can be a legitimate approach, however wiggling with the length of the loan could be a higher thanks to economize. If you'll cut the payments in 0.5 by going with a shorter loan, you'll save large amounts on the entire interest repaid to an investor. The decision on the term of the loan is comparatively easy, however entirely dependent upon your personal state of affairs. There's no fully correct alternative. First, you would like to see if you'll well afford the upper payments that accompany a shorter term loan. In general, a 15-year mortgage can have payments 20 to 25% beyond a 30-year loan. Of course, you'll pay the loan off quicker, to wit, be building equity within the home faster. The modern mortgage business features a type of completely different term length product. Once applying for a loan, take the time to gauge the various terms to visualize if you'll realize a loan that's good for your state of affairs.